Our next guest says that he was pleasantly surprised by the Fed's decision to cut interest rates by 50 basis points. Jeremy Siegel is professor emeritus of finance at University of Pennsylvania's Wharton School of Business. He's also chief economist at Wisdom Tree. And Professor Siegel, this is what you thought the Fed should do, not necessarily what you thought they would do. What's your reaction this morning?
This was the best news I've heard from the Fed in years. And by the way, let me guarantee you an all-time high for the stock market today. There's not going to be a back and forth the way there is yesterday. And the word recalibration is extremely significant. I think what they did is they said, listen, we're 100% towards our target on employment. We've got that back to normal. We're 80 to 100%, depending on what data you use on inflation. And we haven't moved at all until yesterday on the Fed funds. We say, the neutral Fed funds is 2.9%. And, why aren't we closer? We're now thinking about that gap, which is exactly what I talked about a month ago. Not these baby steps. Think about the gap. And now what it is remarkable. In the June meeting, they thought there was going to be one cut by year end. Now the September meeting, and by the way, the data hasn't been all that much different. Now 4 cuts, 2 that we had yesterday, 1 at each of the other meetings. And by the way, I've been looking at the market, figuring in what I see, and they expect 1 cut at every meeting over the next, 6 meetings that we're going to have through June of next year. That will bring the Fed funds rate down 200 basis points to 3.33%, which is where I think it should be. So, this is fantastic news for the market and great news for the economy.
Jeremy, I can't help but think of what our first guest this morning, Roger Ferguson, had to say. He's the former vice chair at the Fed. He wanted 25 basis points, but he said you could make the case for either 25 or 50. His point, as somebody who's been in that room for a long time, is, maybe the market's getting ahead of itself. It got this 50 basis points, and now it thinks that that's the norm, and that these cuts are going to come fast and continuously, and that may not be the case. You said that the market welcomed a big cut and it wants more. What if the market is just getting ahead of itself and those big cuts aren't to come, that this was, okay, we're going to front-end load it, and then we're going to go slowly? Would that be a huge disappointment?
No, because as I mentioned, if I'm looking at the futures market, and by the way, I think right now the Fed dot plot is in almost complete sync once you make that risk premium correction with 25 basis points, not 50. Clearly, if the data gets really bad over the next few months, we will get some 50s. But right now, they will be happy 25 at the November, 25 at December, and then in each of the first 4 meetings of next year, you do another 25 at each of those. That's all you need to get 200 basis points. That brings you down to 3.3%, which is pretty much where I think, the Fed says 2.9 is their long run. I think it's a little higher. I think it's closer to, probably 3.5. So, they don't need 50. They say 20 at this point with these new commitments. What if inflation picks up? Because we're not at 2%. If inflation shows any signs of picking up and the Fed says, hold off, we're not going to do anything else anymore. That's correct. But I don't see any sign of inflation picking up. I took a look at the markets, the oil markets, all those markets going ahead. This Jeff Gundlach was on right afterwards. He said his model actually shows a year-over-year inflation next year when those shelter numbers come in. It's going to fall below 2%. Now, I don't know if that's going to be the case, but that certainly is not a situation where we're off to the races again. The commodity markets, those sensitive markets, they tell you when you're off to the races. They told me in 2020, 2021, it's a totally different picture today.
Okay, Mr. Professor, Dr. Emeritus Wharton, Penn Wharton.
Yes.
You got one side saying, hey, Wharton loves my plan. And then you got the other side saying, hey, I went to Wharton. All right, so Wharton likes my plan. So pick your poison. Pick your poison. Let's see, you got across-the-board tariffs and no taxes on, well, both of them say that. And then on the other side, you got price controls taxing unrealized gains, raising the corporate tax rate, and raising the capital gains rate. Pick your poison. Which of these blockbuster economic plans of the two candidates does Wharton actually stand behind?
I don't think any. I think all of them are, extreme, and none of them are going to be implemented. It's going to be a close election. I think it's going to be a divided government.
You're Mr. Gridlock. That's
it's going to be.
like
it's going to be, and that's exactly what the market wants.
Great.
Harris might be ahead a bit now. I actually think, if I had to come down on, I think she'd win. But I think the Senate's going Republican. The House is going to be very close. You can't get your wish. Either Trump nor Harris could get their wish
and we're
list
both
done. And so, it's going to be blocked. Thank goodness.
Right.
The market,
Thank goodness.
says that.
Yeah, and that's funny. Thank goodness neither of the plans has any chance of seeing the light of day. That's the cynical.
Except for the renegotiate at the end of next year, as we all know, that is the big time renegotiation. There must be a renegotiation of a lot of taxes by the end of next year. If it's a divided government, it'll be a lot of compromises going on.
Should they stay in or come out? Should they be rescinded? Should we get rid of them or keep them?
Well, I'm pretty shocked. The SALT deduction, the Democrats were screaming when Trump put it in, and then Biden kept it when he controlled both houses of Congress. And now the Republicans who signed it are saying they don't want it. Right. So you go figure it out, Joe.